You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Welcome to Tariff Day, or another word is Liberation Day, apparently. I don't know if you're going to feel liberated after today, but today is the day that we're going to have a lot of noise, maybe some real news, maybe some not. It's been a few times that we talk about tariffs, but I don't know. I have to talk about it once more. So even Seeking Alpha called it at the beginning of this week. There is an unpredictable trade policy, growing tariff uncertainty. So we don't know what's going to happen. And before we talk about what can you do about this, a quick comeback on tariffs. So tariffs, long story short, you increase, you put a tax on goods that are crossing a border. Who pays the tax doesn't really matter, because in the end it's going to be one company or the other or both. But at the very, very end of that whole process, the consumer will end up with a higher bill. There's no other way that it's going to happen. So maybe it's going to be fully the importer. So maybe the U.S. companies that is buying good, the U.S. company that is buying good in Canada will pay the full tariff. Maybe it's going to be split with the supplier, the Canadian supplier, because the Canadian supplier do not want to lose their business in the U.S., or maybe they have a contract that they have to cover for that. Maybe it's going to be half and half, maybe whatever. In the end, someone will have to pay more, because on the one side or another, the company's margin is going to drop. And if you have a business and you want to maintain your margin, and then your margin is getting hurt by some additional costs, what do? Well, you try to optimize on one side, try to swallow a bit of that higher cost, and eventually you increase the price so the consumer is paying more. So tariffs are good to keep production inside the country, because that's the way you can eliminate tariff, which is great. But it's really bad for inflation, because on the one way you have inflation because imported goods are going to cost more, and on the other, there are also inflation because there's probably a reason why some of those companies were dealing with other countries, so probably it costs a lot less. So thinking about North Face jackets, they're made in Vietnam for a good reason and not into New York City. There's a reason for that. Probably that the cost of making those North Face jackets would be crazy, and that's why they are in Vietnam. Now, if you bring back that production in the US or in Canada, well, the jacket's going to cost a lot more for consumers. So the problem actually is not a tariff for the market and for your investment. It's the uncertainty that comes with it. It's been already 172 times that rules have been changed over the past 2 months, and that creates a lot of uncomfortable place for investors. So why uncertainty is so bad for the market? Well, in general, the market right now is trying to figure out the price of a stock or an asset today for the future. So they're trying with the best of their knowledge to gather all the financial information, all the qualitative and quantitative information, and then they're trying to say, okay, so what this company is going to look like in 12 months, what this company is going to look like in a year, in 10 years, and in whatever, in the future. And when the current stage of the economy is super blurry, is the tariffs are going to happen, if there will we have a recession, what's going to happen, well, then it's almost impossible to price assets. And because of that, well, the price of assets are going to lower. And here's the question: are you trying to do this for your portfolio? Are you trying to figure out what's the price today for the next 12 months of an asset that is in your portfolio? Well, I don't know about you, but I don't. I'm not trying to figure out what's the value of Alimentation Couche-Tard every single week. I'm not trying to find the value of National Bank or Royal Bank or any other of my assets as of today for the next 12 months. What's going to happen? So my goal personally is I want to hold quality companies, like companies that have robust financial metrics for decades, ideally forever. So whatever happens today doesn't really matter as long as I know that the quality is there, right? So I'm not trying to price anything short term. So whatever happens and how the market perceive like tariffs news right now doesn't really apply to my portfolio. Yes, the portfolio value is going to go down, and yes, I feel the pain with you guys. I get that it's really frustrating to see the portfolio going down. I mean, not too long ago, my pension plan was like at $300,000. Now it's like at 290 or something like that. It's not at 300 anymore. So I've crossed that level. I was super happy about it, and now it's under that. So of course it's not cool, but in the end, I have like plenty of time, so it can recover, and my focus is on investing for decades. Now you're gonna tell me, but Mike, that's great. You're in your 40s, you have like plenty of time in front of you, but that's not my case. I don't have that much time. I am retired, and I cannot wait until the market come back. So here are a few numbers for you. Do you know that for an average bear market, and by definition, a bear market is when the market goes down by at least 20% from its peak value. So we're not even in the bear market right now. We need like a lot more drop to call it a bear market. But for the market to drop by 20%, on average, it takes 18 to 24 months. So a year and a half to 2 years to fully recover. So if you're telling me you don't have that time, you probably should not invest in equities, because that's like 3 years, like 2, 3 years. And even like super large, massive market crashes, like the financial crisis of 2008. It took about 4 to 5 years to fully recover. Like if you have like a well-diversified portfolio, probably more like 3 to 4 years. So if you're telling me again, oh, I don't have 5 years, well, that's probably mean that you're over 80 years old right now. And then again, if you don't have that time, you have like two choices at 80 years old. Either you do not invest in stocks because it's probably not the right place to be, or either you have a focus that you invest for the next generation. So for your children, your grandchildren, so for your estate. And then you come back to having decades in front of you, like not you, but your portfolio has decades in front of it. So the point here is, if you cannot afford to wait for the market to recover, which is not right now in bear market anyway, can you afford to wait like 4 or 5 years? Because maybe that's going to happen until you finally feel safe to invest. Can you afford that? Have you looked at your plan? Have you looked at like what's your investment strategy? And that is a lot more important than thinking, oh, I'm 65, I cannot take another hit. Well, if you cannot take another hit at 65, at 70, that means you should not invest in equities, because like bear markets happen every like 4, 5, 6 years. I mean, just recently we had one in 2018, 2020, and 2022. That's like 3 bear markets in the 5-6 years, in the past 5-6 years. So it happens very often. And if it's okay, if you cannot stand that anymore, maybe you're at another place in your life, but then it's the right time to look at your asset allocation and probably never invest in equities going forward, based on that assumption. So long story short, what you should do for tariffs, nothing. I mean, nothing unless you do not have an investment strategy, you do not have like an asset allocation goals, or you don't know where you go, you don't have like an investment plan or a retirement plan. Well, it's time to have like all of those things done, if it's not done yet. So an investment strategy, allocation strategy, a retirement plan. So super important. If you have that already, well, then you're golden. Like you just actually, if I were you, I would not even look at my portfolio today. Like probably not for like a few weeks anyways, because it's just going to be a lot of noise and incredibly tough to make a decision, like a real good decision on something, because whatever you hear like in the morning is going to be the opposite in the afternoon. So why bother trying to fit like an investment move in this, right? All right, Moose, that's enough for today. If you do not want to miss any of my content, you can register for free to the Moose Market newsletter. So moosemarkets.com/newsletter. Super easy, right? moosemarkets.com/newsletter. You go there, you register, and then you're going to have like a free summary of everything that I've reported of like published or recorded throughout the week on the Friday morning. All right, so take good care. We're going to talk about tomorrow, and tomorrow we're going to talk about my number one trick to avoid investment mistakes. So stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.